Thursday, October 7th, 2021, Maneco 64, home of alternative economics and contrarian views. So for once, I can say that I agree with Janet Yellen. Yes, you probably thought you'd never hear me say this, but it's in relation to this platinum coin idea, $1 trillion platinum coin. I actually said the same. I used the word gimmick. I think it was Sunday during the live stream. So for those of you who are new to the channel, I make a live stream every Sunday at 9 p.m. London or 4 p.m. Eastern time. And I talk about different subjects, and I do Q&A as well. You can ask any question you want. I'll try to answer it. Of course, I can't answer every question because a lot of times I have about 1,000 people all at the same time. But yes, I said it was a gimmick. And I see that Janet Yellen was on CNBC Squawk Box. And she said that this platinum coin idea is a gimmick, just like I said recently. And it's one of the reasons why I haven't been covering it, because I think it's so ridiculous that it doesn't really warrant covering it. But I think it's kind of a distraction from another kind of metal, another precious metal that would really help things, and they don't want to talk about it. And that, of course, is gold, because gold, up until 1968, was used to cover the Federal Reserve's liabilities up to 25%. Up until, I think, the 40s or 50s, I don't remember exactly, it was 40%. So that cover kept going down, how much gold they had to cover the Federal Reserve's liability. And then President Johnson, of course, did away with it in 1968. And we know what's been happening since the late 60s, early 70s to the national debt. And that's why they have a problem with the debt ceiling situation every few years or so. But this idea, not surprisingly, was suggested by Paul Krugman. Who's Paul Krugman? Well, they call him an economist, and he writes for the New York Times. I think he's a Princeton-based professor. He believes that it doesn't matter how much debt we have. And he came up with this gimmicky idea of this platinum coin. And so how come gold would be good to have as a cover? And why don't they talk about gold? Well, because gold would be a really good thing to control and anchor the monetary system. But the thing is, if the powers that be at the Treasury and the Federal Reserve go back to some kind of gold-backed or gold cover system, they would be giving up a lot of control, and they don't want to do that. They might do that, though, if they lose total control of the current system, which is something that looks highly likely. Of course, we don't know when. So just to show you why a platinum idea would be not really realistic and just a gimmick. So if you look at platinum reserves worldwide as of 2020, South Africa has 63,000 metric tons, Russia 3,900, Zimbabwe 1,200, the US has got 900, Canada 310. Worldwide there's 69,000 tons. But if you read here, estimated reserves of platinum metals, total worldwide reserves of platinum metals are estimated to be some 69 metric tons. Almost all of it, 95%, is located in the Earth's crust of South Africa. So there's almost an insignificant amount of platinum overground or circulating. Central banks sovereign nations don't hold any platinum officially, while gold is different. We know that I think official reserves around 33,000 metric tons or thereabouts. I could be wrong. It could be more or less. And one of the reasons gold has been such a great store of value, and it has been money, a monetary asset, yes, and it's been currency as well. It has circulated as coin, is because even though it's a rare precious metal, there's enough of it to make it money. It's one of the reasons why it's money. But platinum is very rare, so it wouldn't work. Yes, it wouldn't work. There's not enough platinum around, and it doesn't have the tradition, of course. And I don't want to sound like Ben Bernanke, but yeah, it doesn't have the tradition of being a monetary asset, of being real money. And people like JP Morgan knew that. When asked what gold was, he said, gold is money, everything else is credit. So we'll stick to Mr. Morgan's dictum. Yeah, so that's why it's a gimmick. Paul Krugman hates gold because Keynesians hate gold. Keynesians want to interfere in the market, in the free market, in the monetary system. They're lackeys for the central banks and for the Rothschilds and those people who want to control us, the globalists. So they come up with this platinum idea. I would say that gold is the way forward, but of course they're gonna try to avoid that as much as possible. We might have some kind of reset, because that's what it would be, a reset, if the gold price went up so much as to provide a good cover for the Federal Reserve's liabilities, or they could do it themselves, like over a weekend. But I think it will be the market that will do it. So with that, I'm just going to tell you some numbers. And a lot of you might say, well, the U.S. doesn't have the gold reserves. It says it's not in Fort Knox anymore. That might be true. A lot of that gold could have been leased out, and they might have had to ship it out. But the United States, the Treasury and the Federal Reserve, they can buy gold just like any other country can through printing their notes. I don't think there would be any difficulty for the U.S. Treasury to get its gold back. And they could always declare force majeure or some crisis. So let's stick with the 261 million ounces that they have, or just, I think, 8,300 metric tons. I've done some calculations, and at $1,750, the gold reserves of the United States and the Federal Reserve, they hold a claim on those gold reserves, because they hold these gold certificates on their balance sheet. They're only valuing it right now at $42 an ounce. But if they were to value it at the market price right now, it would be worth about $450 billion, almost $500 billion. So if you do the maths right now, I think it's covering just over 5% at the market price of its liabilities of $8.5 trillion. That's its size of its balance sheet. Historically, and I'm going to put an article here from the St. Louis Fed from 1968 about the gold cover, and you can read it yourself. But the United States and the Federal Reserve later, because Federal Reserve was only created in 1913, but prior to that, under the gold standard, the United States used to keep a 40% gold cover for Treasury notes. And then the Federal Reserve kept that same cover as well. And then by 1968, it was down to 25%. So let's say we go back to a 25% backing for the Federal Reserve's liabilities. Well, it would be at a price of around $6,500 per troy ounce for gold. At 40%, it would be 13,000. What if those liabilities were covered 100%? And that could happen. That happened in 1980, and it wasn't done officially. It was done by the markets when gold went up to almost $900. Actually, the Federal Reserve's liability were covered by more than 100%. And I think it was Dan Oliver from Myrmikan Capital who wrote about that. I have interviewed him here on this channel. I'm going to put a link to his website in the description. You can have a look at his work. It's free. His articles that he writes. I think he does have a subscription service. So yeah, it would be 32,000, 100%. I think that could happen, but that would be the market doing that, forcing a reset. And I can't tell you if it's going to be the market or if it's going to be the Treasury and the Fed doing it. But I would lean more towards the market doing, because the Fed and the Treasury, the powers that be, are going to try to hold on to their independence from real money, i.e. gold, for as long as possible. So that's also equating to a Dow gold ratio of around 1-to-1. So if gold went to 32,000 and the Dow, let's say, was around 32,000, well, I think we're now around 34,000, that would make sense. So because historically, back in 32, there was a reset after the crash of 29. The Dow gold ratio went to around 2. And back in 1980, there was another reset and the Dow gold ratio went to around 1. So I think the price of gold could go even above the value of the Dow Jones Industrial Average. Again, I don't know when it's going to happen. It could take months, it could take years, but I don't think it will be decades. So yes, for once, I agree with Janet Yellen. So with that, let's quickly look at where the markets are. It's 5 to 9 a.m. London time. We've got spot gold up $4 at 1766.60. We're right near the highs. The high overnight has been 1767, the low 1756. Silver's up 15 cents or 2/3%, 22.75. The low has been 22.47 and the high 22.78. The Dow future is up 0.4% or 140 points. NASDAQ future is up 1%. S&P 500 future is up 25 points. FTSE is up 65 points, just above 7,000 now. The currencies are fairly steady, except for the dollar versus the yuan. The dollar is down about 0.1 versus the yuan at 644.80. Just quickly look at some other currencies. I'll go a bit quicker here. The Aussie dollar is up 1/3 versus the dollar, almost back to 73. The dollar is unchanged versus the Canadian dollar at 125.77. And the Kiwi dollar is up 0.25% at 69.30. So yesterday, natural gas, crude oil were surging. And then during the day, there's a story about President Putin making some comments about considering or sitting down with Gazprom and talking about the gas situation. And natural gas actually went up to that key level 6.5, and then it turned and had, according to what I read from people in the energy market, in the gas market, they said they'd never seen such a volatile day in the energy or gas markets. So that was quite a day yesterday. So is Putin and Gazprom really going to help things out? I'm not too sure. This comment by Putin might have been a little bit put out there by people like the FT or Western mainstream media to kind of calm things down in the energy market. I don't think the crisis is over by any stretch of the imagination. But I thought this comment here in this FT article was quite interesting. It said, Kremlin spokesman Dmitry Peskov said there was, and I quote, absolutely no Russian role in what is happening on the gas market. Angela Merkel, Chancellor of Germany, appeared to lend support to Moscow, saying it was not the case that there were orders for gas that Russia had not supplied. And she said, Russia can only deliver gas on the basis of contractual obligations. And then she also said, that's why we should ask the question, was enough gas ordered, or is the high price at the moment maybe the reason for not ordering so much? And in the case of the UK, we have almost no gas reserves compared to other European countries, and that's been government policy. They've told the gas suppliers not to keep that many reserves, and it's coming home to roost, of course. So let's quickly see where the commodities are this morning. Yes, oil has come off quite a bit. Yesterday we are approaching 79 in WTI. Right now we're down almost 2% at 75.80. Natural gas, yes, it's starting to come off again here. We're at 5.50 right now, down almost 4%. I said yesterday to expect a lot more volatility. Quickly to the bond markets, they stabilized as well after the energy complex came off. The 10-year yield right now is at 152. I think we were at 156 yesterday. And the UK 10-year gilt has backed off quite significantly. We're now at 1.05%. That's still relatively high, I would say, compared to recently. But yesterday we got to 115. So yeah, we need to keep an eye on things because it's not over, this ongoing crisis. And as I've said, it's more of a currency crisis, in my opinion. And yes, we could see even other problems pop up. Earlier this year it was lumber, now it's energy. Who knows what is going to be next? I don't know, but it's something out of left field, I would say. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.